This Week in Startups is brought to you by Real Good Foods is modernizing frozen foods and has become one of the fastest growing food brands in the US. Everything Real Good Foods makes is low in carbs, high in protein and made from real food ingredients. From enchiladas to Italian entrees to breakfasts and more. Real Good Foods can be found in the freezer section of your local grocery store, Walmart or Costco. Masterworks, the first company allowing investors exposure into the blue chip artwork asset class. Twist listeners can skip the 30,000 person waitlist by going to masterworks.io and using promo code TWIST. And Lemon.io. Need to speed up your product development without draining your budget? Hire vetted engineers from Europe at lemon.io. Go to lemon.io/twist to get 15% off for the first 4 weeks.
All right, everybody, the world has gone completely bonkers. Trump is launching a social media company and he's going to SPAC it. Absolutely bizarre. We're living in an upside down world because in addition to that SPAC happening, WeWork has finally gone public and the stock is up 10%. And since everything is going absolutely bonkers, I thought we'd bring a guest on who's doing a great job with his new newsletter. You know Eric Newcomer. He's been on the pod 4 times. He was a reporter at Bloomberg, then at The Information. Now he's on his own. This is his 5th appearance. Coincidentally, Eric's last appearance was on November 11, 2016, right after Trump got elected. And on that episode, the amazing Molly Wood and Eric joined me to reflect on Trump winning the election. And today, we're going to talk about Trump today. Welcome back to the program, Eric.
Thanks for having me. Now I'm independent. I can say whatever I want. You can finally,
absolutely, yes.
I don't have my Bloomberg paranoia or information rules. So hopefully,
well, you basically went from like a super stringent big company, Bloomberg.
Well, I was at The Information first. I was the first employee at The Information.
Bloomberg. Oh, okay.
Yeah, I was at The Information a year and a half, and then I went to Bloomberg, which is even more, buttoned up.
Buttoned up, yeah. And now people can go to Newcomer.
.co, yeah.
.co, NEWCOMER.co, and you can subscribe to your amazing Substack newsletter. You had a great story in there about the GitLab IPO. We'll get to that in our news stories. But you've got a bunch of people subscribing, or is this able to?
I have 11,000 plus total email lists, and I have 1,300 people paying me, $15 a month or $150 a year.
So you're making more than you were at Bloomberg.
It's good.
That's incredible. This is like independent journalism is working.
About half the posts are paid and half are free. It's sort of a mix. I mean, it's on Substack, which has sort of pioneered this model of, sort of a half paywall.
And you weren't part of the group of people that Substack paid to move over there, correct?
Correct. I mean, they offered me like a very small advance, but it didn't even make sense to like get tied up with them. And ultimately, you're running your own business. And so this isn't about the advance. It's
how are you enjoying that versus working? Do you feel you're doing better work working for yourself, being an entrepreneur?
Yeah, I think, you have a much more personal relationship with your readers. I think, I like writing for insiders. So it's very much, for founders, venture capitalists, sort of people really in the industry. So it's nice. Even at Bloomberg, you're sort of writing for like finance people and trying to explain, I don't want to have to say who Bill Gurley is. Like, if you don't know who he is,
want to get to
sort of like, you're not the audience, it's for like, so yeah, I like that. I like mixing sort of reporting and opinion. So it's a blast. I mean, it's a lot more work because I'm editing my own stuff and, you have to keep putting content out.
Yeah. There's no days off, right? I mean, I guess you could take a week off.
I took 2 weeks off actually. And, I was like, this is a premium business. Like I'll take a vacation, but like a holiday weekend is a hassle because then you need to play catch up and you're behind and everything.
Right. Yeah. This is where you will wind up hiring a stringer to do an extra day a week for you. And then suddenly you're going to have 10 people working for you. And
no, after this, I definitely need the Jason Calcanis lessons. I feel like you've done.
If you ever need advice on building media brands, I'll let you know. Employees are really annoying. Be careful, especially writers. Writers are the most difficult to manage.
Right.
Just super opinionated, think they know better than everybody, and in many cases, they're they kind of self-select for very intelligent people who love to debate. So you put 20 of them in a room. Just think about what Jessica Lesson is dealing with.
Oh my God. Yeah.
With all those like incredible writers, like I think what's my interesting theory about this Substackification and, the indie journalist thing is that I think it's going to create a little more empathy between the tech industry and the writers, in that you now as an entrepreneur are going to have a level of empathy and be thinking about business and dealing with business issues, as opposed to just being like in the ivory tower and just,
Yeah, I agree with you on sort of twofold, or at least this has been my experience. One is sort of the reason you're giving, you're running your own business. You sort of realize, that you have to build something, you have a clearer sense of the customer. There are lots of reasons that makes you more aligned. But I also just think the Substack model is much more a mix of reporting and opinion. And there's a way that sort of the objective journalistic style allows for these sort of positions that, they're not fully baked positions. So you're writing with an inherent narrative that no one actually, you don't have to fully think through it. Whereas if you have to write an essay and make an argument, you have to sort of think through what you actually believe, which then makes you understand sort of the entrepreneur point of view a little bit.
Yeah. And I think the connective tissue then becomes not us versus the New York Times, which has now become the New York Anti-Tech Times. Like, they're literally hiring journalists based on how aggressively they will go after tech companies, right? Like, that's literally, when they made the announcement about the last two, they were specifically saying, like, we want journalists who are going to hold truth to power to truth, whatever.
I mean, I like the New York Times. I'll defend the New York Times. But
yeah, it just feels like when you're in the industry that they're just, it feels like they don't write anything that is in any way complimentary or objective about tech. It's just all the dark stuff. So it's like a percentage thing,
Yeah, I mean, the media goes through moods in their story. There was a period where it was all about shiny gadgets, but you go to The Verge, it's still like, people excited about an iPhone. So it exists. If anything, I feel like we should get to a point where there's the media, which is just like reporters, you know what I mean? And everybody else, opinion writers, columnists, whatever, we should just treat them like influencers online. And like, if anything, the elevated status, I think, is hurting reporters because or hurting sort of the sort of intelligentsia of media commentators. Because then people on Twitter can be like, oh, you're a blue check or whatever. It's just like, no, I'm one person with an audience talking, just like if Andreessen talked or whatever. And then you can evaluate, their actual values that the New York Times columnists hold, which is like, I'm not invested in the stuff I cover, blah, blah, blah. But you're a talker now. You know what I mean? So I just rather see that whole world collapse so that you guys can stop saying the media. It's just like, we're saying things.
We're going to have to put them into different buckets, right? Because the average consumer doesn't know the difference between the opinion page and opinion versus reporting. And I think that's why I think the opinion page at the New York Times should literally be like an attachment to it, separate format. And it needs to have like, these are opinions.
Exactly. Yeah, I totally agree. The confusion between those, reporters should be treated as different. They're mostly trying to get information. Obviously, they have bias, but too much of the conversation is this weird mishmash of people not knowing the difference between sort of a columnist and a reporter.
All right. Well, let's start giving our opinions now, since we're just doing random acts of journalism here. Donald Trump just announced his new company, TMTG, or Trump Media and Technology Group. And they're launching an app called Truth Social. You can go to the App Store and search for it. And you can, I've never seen this before, but I guess in the App Store, you can install an app or sign up for it. That's kind of a cool feature. And they're going public via a SPAC. The SPAC is called Digital World Acquisition Corp. It's currently trading under $DWAC. The stock went up 160% on the news Thursday morning, and it was briefly halted around noon Eastern as it became a trending stock on Wall Street Bets. So let's break it down here. According to the press release, Trump Media and Technology Group's mission is to create a rival to the liberal media consortium and fight back against the big tech companies of Silicon Valley, which have used their unilateral power to silence opposing views in America. Initial value of TMTG will be $875 million. There's also a potential earnout of $825 million in additional shares. That would add the valuation up to $1.7 billion. What's your take on this, Eric? Do you think this could in any way be successful?
I'm skeptical just because, the first people you attract to a super niche conservative platform. I mean, this is the problem. Gab had this problem, are going to be really terrible. It's going to be the people who are really on the edge And if they don't want to be censoring people, all of a sudden they're just going to have a huge content moderation challenge. I mean, it's sort of the argument that Facebook makes, right? Being really big, they have the talent, skill, they've hired a bunch of people to moderate their platform. TikTok puts a lot of work into moderating itself. And will sort of this new app be able to, will they have the infrastructure, or is it much more sort of Wall Street bets stock play? That's my initial reaction. I don't know. Do you have a bull case for this thing, or?
Well, if Trump remains off of these platforms, right, Twitter, Facebook, et cetera, if the board of Facebook, their independent Supreme Court, does not reinstate Trump, people love Trump content, and they will probably create accounts. I could. But
that's a website. I mean, you can go to a website right now and see. Why does it need to be an app? And
I would say because the app would be interactive, two-way, and then all the constituents and whack pack around him would be creating content too. So you basically get all of the people, these lost children who were kicked off of all the platforms now have a place to live. And so he did have 70 million people vote for him. 10%, 20% of them still really love him and weren't voting just because, they wanted a Republican and not Hillary. So yeah, maybe they get to 10 million people, but they don't know what they're doing.
Exists, there are Glossier, there are brands that are oriented around far less famous people than Trump. So I guess there's certainly a draw, a single really popular person can build a company around them. But, running a company is hard. Moderating is challenging. The people they're going to attract are going to be sort of the worst of the worst.
Alt-right.
And how do they get mainstream Republicans or regular normie sort of Trump fans on there? Like, I feel like there are a lot of challenges. And then obviously Trump himself is not a great executor,
Well, actually the worst. What does he actually do? Trump University, Trump Steaks, Trump Water, Trump Airlines, everything he touches
he's good at
crumbles.
Marketing, so we're going to talk about it right now. The stock's going to go up, but he hasn't proven any capability to run a company, let alone a technology company.
Yeah, and the moderation I think is a really good point, because is it Gab was the other one that on January 6th, they banned from all of the app stores, basically. Yeah,
I think that's right.
Yeah, I think Gab got banned. So, they have some, if this becomes Insurrection 2.0 planning platform, it's going to get bounced off of the app stores again.
Right.
That's going to be a disaster. I think there's something really horrible about this as well in terms of using the SPAC vehicle, because now it's going to be a money grab. This is going to go, to $50 a share. People are going to lose money. It's going to become a meme stock. Well,
that's a recurring theme of Trump world, right? There are all these games to keep donors, contributing when they didn't even realize it, paying far more than they could afford. So the idea that Trump world is willing to extract money from loyal followers is nothing new, and clearly something that he's willing to do. So.
And here's the thing, tech companies generally have a positioning or a point of view in terms of product, right? Twitter was the short updates, Facebook was the news feed, TikTok, Snapchat, each Instagram filters. Everybody had their own kind of technological innovation. This is done, it looks like they just forked Mastodon, which is an open source Twitter, basically competitor. So it looks like they have zero technology behind this. They literally just threw this thing together, put lipstick on a pig, and forked the open source version of Twitter.
Right.
And they literally didn't have the courtesy to put in the open source licenses. So I think this is a disaster. My professional opinion is this thing will fail. It'll have 5 or 10 million people, and anybody who puts money into it will lose all their money. So if you're a bettor in the public, this is probably the worst. Unless you're a sophisticated gambler, day trading, and you know how to pump these things on Reddit. I would stay far away from this and buy Amazon or Disney or Tesla stock. If you really want to buy a stock, buy one that actually has competent management.
We all know how hard it is to eat healthy when you're grinding on product sprints and trying to meet crazy deadlines. Well, now there's an innovative food company trying to help. Real Good Foods is one of the fastest growing frozen food brands in the US. they're making nutritious foods more accessible to improve human health. And they make all the food you love: Mexican, Italian, breakfast sandwiches, pizzas, and more. Everything is 100% grain-free, low in carbs, high in protein, and best part, made from real food ingredients. They are available in the freezer section of Costco, Walmart, Target, and 90% of grocery stores nationwide. When I found out about them, I went into my Instacart, I went out to Amazon, they were everywhere, and we've been eating the pizza. It's delicious. Plus, you can get them delivered same day by Instacart. Real Good Foods is healthy, convenient, and tasty. It's perfect for any lifestyle. Plus, part of their mission is to support food banks across the U.S., and they have a goal of donating 1 million nutritious meals. Nicely done, Real Good Foods. So, go to realgoodfoods.com and use the code TWIST for $15 off. Learn more and follow at Real Good Foods on social media, or go to realgoodfoods.com and use that code TWIST to get $15 off. All right, WeWork finally went public Thursday via SPAC, and the stock is up 10% as of this taping. Back in 2019, we had the famous WeWork S1, all kinds of shenanigans in that. Adam Newman was buying buildings, then leasing them back. He was selling the trademark We to WeWork for $5 million. The malfeasance was just brutal and disgusting. If you haven't seen the documentary, you've seen the documentary, I take it, the Hulu documentary?
Well, I read the book. This is a classic reporter. I don't think I actually have seen the documentary, but I read Elliot Marine's book on.
Yeah, and then there was Reeves' book, $1 Billion Loser, The Epic Rise and Spectacular Fall of Adam Newman and WeWork. We had him on episode 1130. And they were going to go out at $47 billion. And that was in mid-2019. And according to a Barron's article from March, quote, SoftBank holds about 65% of the equity in WeWork. And so I don't see what the market cap here is right now, but if they own 65%, according to CNBC, it's at $9 billion, right? So they now, I guess if we rounded up to 10, that's a $6 billion or so. And do we know how much WeWork pumped into it? Are they actually going to come out of this even?
Didn't they put in I thought it was like a 9 billion, 10 billion, something. I mean, they put a ton of money in.
They might be halfway there, which is really super interesting.
You have to be able to exit, obviously.
Yes.
If you own that much of a company. And I'm sure a bunch of the value is predicated on SoftBank's perceived commitment to it. They start selling out. It'll put a lot of downward pressure on
SoftBank invested $18.5 billion.
Oh my God.
Oh my Lord. So they got to triple up here. The company's got to become worth $27 billion for them to break even.
Well, yeah.
But you know what? To save a third of your money on your worst investment, pretty good, right? Expected revenues, $3.2 billion, over 450,000 members. I mean, it's not a terrible business. I actually think, I'm curious what you think, isn't this business perfectly aligned for the, work from home hybrid where people are going to need to use space on a more flexible basis?
Well, that's the irony of the whole situation, right? If Adam Newman had committed slightly less fraud, had made it to the pandemic, this would seem like a smart business to have emerging from the pandemic. You would have even had sort of this nice reset period where you could have sort of fired a bunch of people, cleaned up the business. There is an alternative storyline where if he just held on slightly more normally, he could have come out of the pandemic and pitched the business as having, an excuse for why it suffered a bunch of losses and layoffs. But yeah, I totally agree. I mean, this is a great time for WeWork. We're seeing more people like myself become sort of solo entrepreneurs. So people want offices and also just temporary workspace, and companies are distributed. So the thesis, it was always sort of a cool idea. Yeah. And that's what becomes dangerous, right? The idea is so gripping and compelling and socially resonant that people stop paying attention to the financials and the losses and
unit economics.
The mechanic. Exactly. It's easy to just it's a story stock, and in this environment that can go forever. And obviously Adam Newman pushed that theory too far.
Yeah. If you need only look at the on-demand economy, which they were part of with Uber, Postmates, Lyft, DoorDash, Airbnb. The on-demand economy really, was super promising because users loved it. It was a great product. All of them were great products. But we had things like Lux, the valet that would meet you anywhere and park your car for less than it cost to park it in a lot. And the unit economics there didn't work. some food delivery didn't work until they put minimums. Instacart wasn't working. They had to put a membership fee on. And so it's sort of like the great reckoning of unit economics feels like it's upon us. And
there was an interesting column. Greg Bensinger at the New York Times, who used to be the Wall Street Journal beat reporter, had a smart column on Uber and sort of the reckoning on unit economics. I mean, we're still seeing that play out. I mean, it's been a terrible experience getting Uber in some of these cities. And obviously it's a two-sided marketplace and they have to be able to get drivers, and that drives up, price. So I think that, and I mean, Instacart is still a private company and they really saw an advantage from the pandemic. So I think it's still possible. There's more of a reckoning there, but WeWork has reset expectations. And so hopefully there's
and even
there's
Uber and
some
Lyft are
there.
like, this is the quarter where they just started to hit, like a reasonable break even or a modified EBITDA. And actually, if you raise the prices, this is what I always said, like if they were losing 50 cents a ride, if you raise the price $1 or $2, now they're wildly profitable. Like, why don't they just raise it $1 or $2? And they've been doing that. And they cut their staffs, at Airbnb.
I think the reason I think is just that they were predicated on being able to disrupt transportation wholesale, which required underpricing.
Yes.
People are very price sensitive. And so if you want to show a big TAM, you need to keep prices low. And they wanted to downplay the inherent trade-off between their profitability and the potential TAM. And so I think that's why they delayed for so long.
Yeah. And if you think about it, they were trying to make Uber Pool and Lyft Line work, and maybe there was something there. Maybe the algorithm could make it work, and it maybe that those products just don't work.
Definitely not. Don't work. My friend Tom Dotan at Business Insider wrote a piece basically about this. I mean, the pandemic was definitely like a cover to get rid of Pool, which wasn't really working. And they had pitched for years. I mean, that was supposed to be the future of the business, sort of more sustainable, lower prices.
Well, it would build liquidity, right? Because you'd have so many more cars on the road, and they would always be running.
Yeah, I mean, I love the vision, but it doesn't work.
Vision was good.
Or at least Dara couldn't execute it. Yeah.
And there's other visions that work easier. So, do you just capture the top 50% of the market or the top 60% of the market and say, you know what? For people who are in the bottom third, public transportation is a better option at $3. There's not going to be a $3 or $4 Uber. The minimum in Uber is going to be, and a Lyft is going to be $7 or $8.
Are you all sold out of Uber?
No, I still believe the company is going to do well, because if they weren't the leader, like if I was in Lyft, I might feel slightly differently about it. But because they have the trucking business, the Eats business, and Uber, have sold a lot of it before they went public. But I think the company will be, they're growing 20, 30% a year on big numbers. And I think, they have the perfect guy in there in terms of optimizing it. He's like really good at that. And they've got, whatever it is, $14 billion worth of equity in other companies and a big balance sheet. So I think they'll be the last person standing. I know this is your show,
but do you ever see Travis anymore?
I try not to talk about Travis, but we've remained friends and we see each other. Yes. And so I just, he is being very low key and does not want to talk about cloud kitchens. But,
every friend of his I talk to, they're extremely, they claim to know nothing about cloud kitchens, whether that's
I know a lot, but I know nothing. Well, here's the thing, he really helped make my career. I helped him, obviously, in a minor way. And, he got, really destroyed and he wants to focus on his business. So focus on your business. And, I respect that he's got his head down and he's just working. But, I think he will build a business with cloud kitchens that will be as big or bigger than Uber. I still believe. I
don't believe that's the consensus view. I mean, I have no idea, but it'll be. I mean, the pandemic was obviously talk about. I mean, if WeWork is a cool coming out of the pandemic story. I mean, cloud kitchens with these ghost kitchens was built for the pandemic, where food delivery goes crazy, restaurants are shutting down. So
I think your instincts are probably absolutely correct. Heads up, the days of the 60-40 portfolio might be over. 60% stocks, 40% bonds. Bank of America and Goldman Sachs both agree. Mounting pressures from inflation and the Fed's upcoming tapering deadline might slow down the economy and could cause trouble for stocks and bonds. I think we all know that. So diversifying is more important than ever. It's also important to look at alternative assets uncorrelated to the stock market, like contemporary art, according to our friends at Masterworks. Many savvy investors, you might know some, hold 10 to 30% of their net worth in art, and here's why. Well, according to Masterworks research, contemporary art appreciated 14% annually between 1990 and 2020. It's a pretty good 30-year run, if I do say so. Now, you can invest in blue-chip art without paying tens of millions of dollars. Masterworks makes investing in iconic art like trading stocks online. They securitize a multi-million-dollar painting, and then they sell shares to investors. I've done it. It's really easy. And they just raised $110 million Series A with a valuation north of $1 billion. Congratulations on becoming a unicorn. And guess what? Twist listeners get to skip the very long wait list to get on Masterworks. If you want to invest, just go to masterworks.io/twist to get priority access. That's masterworks.io/twist. And make sure you read the important disclosures at masterworks.io/disclaimer. All right, let's get into your recent story. This is a pretty crazy story. Everybody knows GitLab went public. GitLab was essentially...
There's GitHub and GitLab.
Yes. So explain to people the difference between the two companies.
Sure.
Obviously, we know that GitLab recently went public, and it was a massive windfall for a lot of venture capitalists. But as you are really good at doing, you found the backstory here. So tell us about the companies and the backstory.
Yeah, so, GitHub was sort of the early mover, a code repository where you could, go and show what projects you've been working on, work on open source. It became sort of a mix of like a LinkedIn for coders and sort of a resource for finding code. And then GitLab comes out of Y Combinator, years after the founding of GitHub, and is basically trying to build tools for enterprise. It's not the social network. It's more like, okay, if you're a big company, where can your coders sort of keep all their code? And, so it comes out of YC, and I write these story of the cap table pieces, which are really, you look at the S1 and you say, who's the biggest holder? So I saw, okay, it's Khosla Ventures is one of them, August Capital is one of them, Iconic is one of them, and Google Ventures, GV now, is one of them. And then
those tend to be people who own over 5% get listed?
Over 5% get disclosed.
Right. That's why I always dodge the bullet.
Yeah, I know.
Have multiple entities. So even if I do own more than 5, they're broken up.
Some of these I try and go back and, if there's a good angel investor story, I'll tell it. This one, I didn't as much. But this guy, Kassar Yunus at YC, I think, was sort of a big proponent of theirs there. And he introduced this. So Ben Ling was at Khosla Ventures, and he was sort of just, going through the YC portfolio. He meets with Sid, the founder of GitLab. This is back in March 2015. And then basically, Ben believes in it, hands it off to Sven Stroband, the CTO at the time at Khosla. And it sort of just documents, how investing works, which is just, it's extremely interpersonal. It's like who can refer you, even on something super technical as GitLab. Obviously, Sven is sort of more the coder guy, so he can assess the company and come to a view of whether this is actually like a good idea. But to get the deal and to start thinking about it, it's like, who do you know at Y Combinator? How does it work? And so I love to chart that out, how even within the firms, it's so interpersonal, and that there's so many random things that happen that make, I did one of these on DoorDash, and literally Sar, who was at CRV, he was going to invest in DoorDash. He was looking at another company, and he happened to talk to the general manager at Orange Hummus in San Francisco, who said, actually, I don't like that other company you're looking at, but I like DoorDash. And that's how he found it, so I love sort of just
the randomness of it is,
I love
it's very
the
real.
world's so human, you get all these numbers, you're starting from an S1, you see ownership, and they're huge, we're talking about billions of dollars, but at the end of the day, as you know, as well as anybody, I mean, these are such like personal things, right?
So YC gets 7% of the company for $150K. They get diluted down, obviously, so they probably didn't show up on the S1, I assume.
Right. I was talking to someone the other day. I think the standard YC is like owning like 3.5% probably. So that, it's below the 5. And if you do that math, maybe they own like 450 million. I mean, that's extremely ballpark on YC, but obviously it's a great return.
If you did 3 or 4 rounds at 20% each, you're looking at 50-60% dilution. If you started at 7% of common, you get down to 3.5. But they do have a continuation fund. That continuation fund might have put money in, but that would also be under a different entity, so therefore it wouldn't go above 5.
Right.
You wouldn't see it either because it might own 1%, 2%.
Yeah.
So then August invests at that $27 million post-money valuation.
Right. August is the best part of the story. I mean,
yeah. Tell us that part.
That's where the drama is here. I mean, basically, August Capital had this guy, A.B. Katz, who's an associate. So, sort of, the total growth.
Oh, and by the way, Ben Ling, he's at Bling Capital now. Ben Ling Capital.
Yep.
He did the seed round with Khosla, which means they put in $1 million or $2 million and own 10 or 20%. They do the seed 10%.
And the A. Yeah. And so then August Capital, so this guy, A.B. Katz, after the seed round,
An associate
is just like on Hacker News, sort of a nerdy guy, super deep in sort of the San Francisco tech scene, starts tracking GitLab and is bringing up to his partners. So Trip Jones, who's a partner, they meet with GitLab CEO Sid, and they bring him into the partnership. And the partnership, some of them sort of like, old school VCs are really skeptical. I have this great quote. The company seems like, quote, the antithesis of everything a smart VC held to be true. Because GitLab was open source. It was fully remote when nobody believed in that. And then, it was coming behind GitHub and it was competing with Atlassian. So it just seemed like such a crazy company. So then August Capital doesn't invest in the A. Khosla invests in the A. And then, then this guy, Vili Ilchev, comes in May 2016, joins August. He had worked at Box, LifeLock, Salesforce, and most importantly, while at Salesforce, he looked at GitHub around the acquisition of Heroku. And so then Illy really becomes a big believer in GitLab and really like vibes with GitLab CEO and then really pitches the founders.
And he's a partner.
He's a partner.
Got it.
And then August Capital, they're still like, I don't know, we're worried about it. And David Hornick, who's sort of like the big time guy who'd invested in Splunk and made a bunch of money, has some reservations. I mean, Hornick was very defensive with me.
I saw the quotes. I mean, he gave you a lot of
he sent me like a long email because, I was like, oh, I'm going to say you were like not into this deal. And he's like, everyone had some reservations about the deal. It was anything but a sure thing at the time. I was no more vocal about my reservations than anyone else. Anyway, and Vili's very,
probably
nice
directionally correct, but your guy told you he was dead set against it. He was fighting against it. No,
I just said he had some reservations. It's just, there's a certain irony. I'm not saying obviously the deal happened. The partnership has to agree. Hornick was super key in selling it. So I'm not trying to insult him. It's funny in light of how the story ends. It's not so, which I'll get to in a second.
Yes,
it's not so much that he was like dead set against it. It's just like he wasn't like the champion of this. Like Vili was the champion of this. This guy AB was the champion of this. And then, Trip, who was another partner, had sort of been involved in bringing it in and was really listening to AB about it. So anyway, Vili gets it done. They invest $14 million and they end up with an 11.1 stake in GitLab at the IPO. The stake's worth about $1.6 billion. So you invest like $15.5 million altogether and you get 1.6. Yeah, exactly. It's more than 100x return.
On a big number. It's not 100x on a 25 or 50K check. It's 100x on a 14 million, 15 million.
It's huge. I mean, and the fund itself that they're investing out of was only $450 million. So they've more than 3x the fund.
It's $1.2 billion in profit, which means 20% of that carry would be $250 million.
Yeah, and there are other companies.
And they might have a ratchet there where if they, double, they get to 25% or 30%. Yeah. So this could be $300 million in carry. I would put it at $250 in carry.
They're always more, VCs hate to talk about it. They're always more. Yeah, no, I love it.
When you are trying to grow a startup fast, hiring engineers will slow you down like nothing else. Don't I know it? So many companies I invest in are telling me they can't get their next version out because they don't have a great engineer. Well, Lemon.io will find you a perfect candidate in just 48 hours. It's a marketplace of engineers from Europe, and they test and interview every developer to eliminate the risk of a failed project. Lemon.io is the perfect solution if you are a technical co-founder and you need to delegate some of your important tasks, or you have a project that needs specific technology and you don't have that skill on your team yet, or you are just growing so fast that you need to add more developers and get more done faster. They'll match you with a candidate within 48 hours, and if it doesn't work out, they'll replace the developer right away. So here is your CTA, the old call to action. If you could use a full-time or even part-time developer to run your projects faster, go to lemon.io/twist. Once again, lemon, LEMON.io/twist, and you'll receive a 15% discount for the first 4 weeks of work with that amazing developer. Well done, Lemon. Okay, check it out, everybody. Lemon.io/twist.
So then August Capital, they're trying to raise their next fund, and there's some resistance from LPs. It's just, there hadn't been a lot of exits. People have been worried about a bubble forever, and it was hard.
And August didn't have tremendous returns. They didn't have a big breakout like this previously.
And it's hard to know GitLab's going to be huge,
Right. But they didn't have a GitLab in the previous fund or the past two funds, I would guess, which is why they were having a hard time. If they did return 4 or 5 times the fund cash on cash, they would have an easy time raising a fund.
Yeah, I'm not sure. I know they exit Fastly.
That was a good one. Yeah.
And they exit, I have it in the story. I'm looking for it. It's like Fastly and Bill.com. I'm not sure which funds those were, but I guess they hadn't exited yet. But then once they exit, LPs are more convinced. So basically, Hornick and another partner sort of say, we're not going to take more, we're not going to invest more. We're basically going to pause. We're not going to take in all this money. And it takes all the people around GitLab, which is like the great investment of Fund 7, by surprise. And so Villy leaves, and everybody's sort of in this weird position because if you're a VC, your funds vest generally. So it's not
7
like
years is the
so
standard.
you need to stick around because it's supposed to be a long-term business. So basically the story is just like the guys who made this firm a fortune were sort of screwed over by the sudden shutdown of August Capital. Now August Capital exists.
So they shut down August Capital because they can't raise a new fund. They
VC
say we're going to stop
they
investing
didn't,
7.
Right. They didn't invest. They weren't going to raise a new fund, and they were just going to sort of manage out 7. And then suddenly, some of the guys who are involved in August start Lobby Capital, which is, a very related firm that has some control over August Capital. So you can sort of see
Capital had started a conference over 10 years ago called The Lobby. I was invited. I never went because I was running my own conference at the time. And
right. The key thing is to run a conference, not to go to conferences.
Well, yeah, exactly. And so, but people love the conference because it's just a boondoggle. It was invite only, 200 or 300 VCs and founders.
Right.
And so they shut down August, but then they create Lobby Capital with the same 2 founding GPs.
Right. So it's sort of, it feels like a little bit of a game to shed maybe some of the partners and still have control. But I don't want to say anything beyond, what I said in the story.
Well, the cynical view of it would be, if you have a 7-year carry, so let's say the associate, I can do the math for you here. An associate would get 1% of the firm's carry. Okay? 20 points of carry, they might get 20 basis points, which would be 1%, right? 10% would be 2 of the 20 points. So 1% of the $250 million carry in that one deal would be $2.5 million. Associates getting paid $150,000 or something, $100,000, $200,000, who knows? So it's a pretty nice payday to get, 20 times in your first job. Associate's like the first job. The other partner is a junior partner, or maybe not one of the 2 founding partners. The 2 founding partners are probably getting 6% each, 6 points each, which would be 5 times that, 30% of the carry. That partner maybe has, let's say, instead of 1% of the carry, maybe they have 5% of the carry. 5% is, 15 million, 12 million, something like that. Now, if they're on a 7-year vest, they're 3 years into it, where does that other half of the money go? Where does the 1.25 go? Where does the other half of the 15, the 7.5 go? Goes back to the original founders because they don't have to pay it out. Just like if an employee leaves Uber or Google early, those shares don't get issued. They go back to the founders, or all the shareholders get that benefit of those shares not being issued, right? So that would be the most cynical view of this. Now, if they did shut down the firm, they might say to the other partners, we'll accelerate your vesting by a year or 2
so there are a couple
as a thank you. And then they would make them sign a non-disclosure, which means you would not get it, because if they did, they'd have something called a clawback.
Story. It was
that's because there's a clawback. They probably gave them 2/3 of it, and if they talk about it,
sourced,
they get their money. The founders get to take the money back.
So So it seems like Villy, the guy who really landed the GitLab deal, probably got at least some of his carry accelerated. And then AB, the associate, I mean, he was just an associate, and it seemed like they gave him some carry for playing the role. So I'm not saying they've been totally ungenerous. I mean, it seems like one of the other partners sort of stuck around after it really made much sense. I would infer that was to keep vesting, but it was a very painful situation for everyone involved. And there is like, even in stories where you don't have a firm shutting down, there's a lot of credit taking in the VC business because everybody has a fair position, right? The top guys are like, well, I worked my way up. And part of the value is you have some associate working for you who does deal flow. They find stuff and you have to decide whether to do it. And then you get the credit and then they get to get promoted and then they get credit. 100%. That's sort of the old school flow of it. But then, I mean, I think we're in a world where it's much more individualistic. People don't stay at their firms forever. And so now I think there is much more like who actually found this deal? Like, and then what parts of sourcing and, getting the deal done were most important. And these stories dig up, get into the specifics of that in ways that firms would just like to say, the venture firm did it instead of. But I thought this was a funny quote from David Hornick. He's like, sometimes the deal business is more mundane than modern folklore would suggest. And in the end, great successes like GitLab have many fathers, while great failures die as orphans, which is both true, but then also obviously that's true because of how people tell these stories where they all want to make themselves the key player in getting a deal done.
Yeah, and great reporting, by the way. And I just love the format you're doing at newcomer.co to break down the cap table like this. Very informative. We get to see this, and now cap tables are getting tightened up because of Carta. When I go look at a cap table in the old days, like I have in my email, the Uber and Robinhood cap tables, like they would just send them to you in an Excel sheet. And that's how I met a lot of my contemporaries. This was a hack I did, and I actually wrote about it in my book, was just take out the cap table, look at the other names, Google them, find those people, and then say, hey, are you an investor in Robinhood? And if they say yes, then go have coffee with them and ask them to share deal flow. So literally one of my big playbooks of how I became successful was I just looked on the cap table. I was like, who's this guy, Chris Sacco? Who is this person, Cyan Bannister? I'll invite them to my next event. So I built my network that way. Now, when you go in Carta, it obscurifies, it's opaque who's on the cap table. What you'll see is the seed round has this many shares. It's this percentage. You have this many shares. The pro rata is this, but it blurs all that. So whether you're using cap table IO, cap base, take,
that way.
You can restrict by levels. So
that's sad. There's so much information in cap table. I mean, it is. Yeah, I love just going through PitchBook, and that's my version of it when you're not getting the real thing and just seeing. Yeah,
PitchBook has a little bit more granularity, and then people would leak cap tables now and again. There's very famous stories about cap table. I mean, that's how the Wall Street Journal did the story about my Uber position, was somebody leaked the early cap table, and it was like, okay, well, there it is.
And some of these stories, I think the DoorDash one, I'll get, the people below 5%. It just depends what I'm focused on in the story. I mean, they're not that tightly held, obviously.
No. And there's all kinds of wacky stuff that happens on cap tables, and people get bought out, and there's all kinds of stories like of early Uber investors who sold in the Series B. Like it was very famous that Techstars, I think, had a fund, and I think they got offered, at maybe, it was past the Series B. It was maybe like $4 billion. And there was a secondary, and I talked to Travis, and there was this like secondary going on. I was like, what's this? Who's emailing me? And he's just like, yeah, don't sell. And I was like, okay, thanks, pal. And
then, that's Saka, with Twitter and I think Stripe has made a bunch of money just buying from other people who are foolish enough to sell. I mean, obviously some of it is, if you're an exec and you want to be rich now and not rich in 5 years or whatever.
If it's your only holdings, if it's 95% of your net worth, it's a very smart idea to get it down to 50% or something, right? You want to ride your winners, but you don't want to, as we've seen with WeWork, you would have been wiped out and got zero. So you're sitting there with the $47 billion WeWork with an $18 million preference, right? There's probably more, 25 million in the company, 25 billion rather. Now the company's worth 9 billion. You know what that means to the common? $0. Like you get nothing. You're wiped out. And maybe some early investors got just severely wiped out as well.
I don't know. Honestly, I'm interested to know what happened in the if a direct listing versus an IPO would have had a different impact on the preference stack or anything. If there was
Well, in an IPO, all shares convert to common. But what can happen is if in those later rounds, because they're so spectacularly large, there's a clause that says, if this is, we're buying into 30 billion for Airbnb, let's say, I'm just making this up. If it goes down to 15 billion, you got to give us 50% more shares.
I get preference stack. I'm saying that a SPAC is technically a merger. And so I don't know. It's just reportable. I just like, whether they knew to protect against a SPAC versus
I think
IPO,
probably, with SoftBank owning 65%.
Right.
That was a recapitalization moment where they recapped the company and probably wiped out the common.
They fixed it then. Yeah.
They fixed it then to that. And a lot of times when they do those like really ugly recaps, I've been involved in them, it gets really ugly. And the best thing is when they just say it's pay to play. So, okay, the company's going from 47 billion down to a $6 billion valuation. We're raising 3 billion. All the common is now wiped out. All the other preferred is wiped out. Everybody's wiped out unless you participate in this. So you have to put more money up. And that's the way you legally protect yourself. Does that make sense? Because you had the opportunity to buy. It's not like you were excluded from buying the shares at this new price, this discounted price. Or they do warrants. They could say, hey, for every share you buy. I'd love to
know how benchmark, if they're going to make some money on this. Because they were the Series A investor.
The rumor I heard, just a rumor, is that they may have took an opportunity to sell in secondary.
Yeah.
In those increasing rounds. Because remember, they were seed or Series A. Upside. Were they the Series A or the seed?
Series A, yeah.
Series A. So
I think
when Masayoshi-san shows up, he's buying as much as possible. And if they owned, let's say they owned 15% at that point, completely conceivable that they sold 10% to Masa for $500 million or something at a $5 million valuation, locked in their returns.
That's been my assumption, that they've made money off this thing.
I think so.
Right. With the WeWork story, the reporters love to make it sort of an indictment on everybody who touched it. But there is a degree to which investing in this charismatic messiah founder at a Series A can make sense, even if they're sort of out of control.
Well, the thing is, you don't know they're going to be out of control. And actually, it looks like SoftBank's first investment in 2017, Benchmark cashed out $129 million for an 8x return on the initial investment. And I assume they had some idiot insurance. They still had some shares.
Right.
But to your point about the craziness going on right now, the amount of fraud, the amount of
WeWork's lawyers are going to come after you. They're insistent there was no fraud allegation. You can say whatever you want.
No, I wasn't talking about.
I know
WeWork.
you're not saying
I'm saying
about
the amount
WeWork,
of fraud
but
I'm seeing at the industry writ large.
They're running around.
Are they?
I think so. Yeah, that is.
Wow, that's interesting. Yeah.
Yeah.
Well, I would just say unethical behavior on the part of what I would consider unethical. I wouldn't say the word fraud. Yeah. But what I'm saying is there's a lot of people right now. I think the industry has probably got a 5 to 10x the amount of bad behavior, malfeasance, borderline fraud, shaping of stuff. I think we're going to see, so many lawsuits and allegations in the coming months. Because I don't know if you saw, there was the person who had a SaaS company. What was the name of it? That just got sanctioned by the SEC because he faked a head spin. They
I saw that. Yeah.
It was headspin.
that one was egregious. That one, I never really
just
followed
straight up
that.
lying.
Right.
They had like 40 million in revenue or something.
Company, GV.
Yeah.
So it was legit investors.
Well, here's the thing that's really scary that you should really be, as a, somebody who's deep in this, my little like, hey, look over here kind of moment. If you're, if people are dipping down and they're relying on the Series A and the Series Bs, or the Series A and the seed and the Series A investors' diligence, and they're just coming in saying, I can do a deal in 48 hours with you at this crazy price.
Tiger Global, yeah.
Well, I'm not talking about anybody in specific, but let's just say they say as part of their aggressive approach, we don't need to do diligence. We can just do a quick investment. We know you got great investors. What I can tell you is, I do a very serious diligence process. People think I'm nuts because we'll ask to see bank statements. We'll ask to see the iTunes sales reports. We'll ask to talk to their accountant. We'll ask to talk to the top 3 employees. We'll ask to talk to the top 3 customers. We do diligence like we're a Series A firm, even though we're doing seed. And since we started doing that, we uncovered a lot of problems that then led us. I'd say it used to be 1 out of 10 times. Now it's maybe 1 out of 5 times.
Wow.
We'll pass on a deal. Now, I'm pretty sensitive. I'll see something like somebody owns 30% of the cap table because they went to some fakaka crazy accelerator and they gave 30% to a dev shop. And I'm like, I'm not investing in this because I know it's going to screw up the future rounds.
Right.
I'll buy them out, or you can buy them out, or get them down to 10% so we can clean the cap table up. But that's your choice as the founder. I don't want to force you to do that. I'm just telling you it's going to be hard. So what the problem is I look at my contemporaries and some of them don't read their legal documents. They don't take the time to spend $1,000 or $2,000 on a legal review of the documents. They don't even know what they signed. They don't do diligence. They say, you do diligence, JCal? I'm like, I always do diligence. They're like, oh, okay, great. I'm like, okay, great, what? And it's like, okay, great, I don't need to. And I'm like,
right, we can free ride off of you.
Well, and I think what's happening is there's a lot of suspending of disbelief in order to win deals. So what are people doing to win a deal in a competitive environment? Not doing diligence, not taking a board seat. Okay, how does that play into a sociopathic person like, Elizabeth Holmes, or somebody who's just a freak like Adam Newman?
Right.
No governance. How did he do with that? Not well. Okay. No diligence. How did that go for Theranos? Not well. Now add to it. In order to win the deal, I will give the founders a bucket load of new equity. I'll re-up the founders. And now the founders looking at 3 term sheets. One is doing no diligence, no board seat, and they're going to give them an extra 10, 20% of shares of the company. And the other 2 are from Bill Gurley and Sequoia and whoever.
Right.
And they're saying, let's do diligence. We're going to take a board seat, of course. And then, if you want to give yourself more shares, we'll have a compensation committee. We'll do a proper review. And the founder picks that one. That to me is fraud, or it's borderline fraud.
It's just...
It could be if you were not acting in the interest of the shareholders.
It's funny that you're taking the more conservative line than I am on this. I mean, there's a degree to which, it's just the sort of Andreessen philosophy that like, some of the disasters will get washed out in the good, and then it's better to deploy a bunch of cash and get in it, has been validated in certain ways,
until the tide goes out.
But even SoftBank, right? I mean, which is the sort we saw with WeWork. I mean, Coupang, Didi. Now, some of those they might get hit in some of the China retrenchment problems.
They'll still return tens of billions of.
They're still getting tons of exits. So there is a degree to which, if you're playing for big and you're like, well, I want to be the king of the bubble, the bubble blows up, I'll be the most destroyed, but I'll be infamous. And if the bubble goes, I'll be the biggest. That's sort of a worldview that says, yeah, exactly. Diligence.
I'm kind of like in the
I obviously respect the benchmarks that you're doing it the right way. That is, I'm a reporter though. I'm sort of like, obviously I'm inclined to manage downside.
Show me the train wreck.
I want the truth. No. I'm saying I like people who care about the truth. You know what I mean? And don't say like, well, enough money will, solve the truth or whatever. But clearly the people who've been bananas have been rewarded in certain ways. So I can see why people just keep playing that strategy.
Well, I mean, also just look at crypto. Like people are suspending disbelief. They're like, here's my next NFT project.
Right.
Yeah, I'll put $50 million into that. It's going to buy me tokens, and it's going to go into some offshore, Panamanian Zerg nonprofit, and we don't know who's on the board of it. Like, there's a lot of suspending of disbelief in crypto.
Well, this is sort of my position on Coinbase, right? They've become so successful despite, I wrote this story about Gary Tan, right? Gary Tan was a Y Combinator. He starts Initialize.
Awesome founder,
He's great. He invested in Coinbase super early because he thought Bitcoin would not be some speculative tool, but a medium of exchange, like something that, people could pay with. That has not been borne out. It is still a speculative tool, but it doesn't matter. He got rich on Coinbase anyway. The reality is that Bitcoin has gone up so much that even if, it comes crashing down, a lot of the people who bet on it early have made their money. And so what's reality at that point when it's like, well, the speculation went on long enough that they've been able to exit, $100 billion or whatever valuation Coinbase's company. It's sort of like you throw up your hands about reality at some point because it's worked.
For me, it's like, if you're going to do this stuff, it's worth doing right and to do it in a button-up fashion. And so that's just been my message to founders. Like, you take these shortcuts. You might be building, this giant building on a shaky foundation, and it could collapse. And you know who gets hurt the most? Not the venture firm or the angel investor with 100 investments or 200 investments in 7 funds. It's the founder and the team members who are, living in the building who just got crushed when it crumbled. You're the one who's going to take the biggest hit.
Right. I know you're not going to talk about your friend, but there is a degree to which if Travis had listened to Bill Gurley more and moderated slightly, I mean, maybe Gurley was wrong on going to China or whatever, it still probably would have meant that he was still in his job, which might have been worth it.
It was that's certainly going to be an interesting, in 10 years from now, we'll have an interesting debrief on that one. I think Clash of the Titans. I'll leave it at that. I still remain friendly with both,
the show is still going to come out. It's like amazing that this is the story, even though Uber, the business, is not like a once in generation company at this point. Uber, the story, is like it's a huge it's cultural phenomenon.
I have a feeling like Uber will be worth 5 times as much 10 years from now.
Really?
Yeah, I think the people are underestimating. What being
they've
the
sold everything off.
At something means. What's that?
I feel like they've sold everything off.
They still own those positions in Aurora and the VTOL companies, and they get to monetize them without having to run them, and then they get to focus like a laser just on transportation, logistics, and shipping. Things. I think it's going to be a very prescient play for them, and I think self-driving, which everybody thought would be the death of Uber and Lyft. That's why the New York Times story didn't make sense. They were like, that's going to be the thing that saves them. It was like, that was the thing that was going to kill them, right? And I think self-driving without the person in the vehicle is, 10 years off in San Francisco, New York, LA, Tokyo, like at least 10 years.
Right.
I do think Tesla Autopilot works. I've used it all the time. I don't have the most recent beta, but you do need to intervene. So I think regulators are not going to allow the driver and the steering wheel to go for at least 10 years.
Yeah, I have not been. I've been skeptical about self-driving for a long time, but it was a fun story for a while.
Yeah. All right, listen, everybody go subscribe right now. Let's get another 100 subscribers for Eric so he can hire somebody so he can take 3 weeks of vacation next year.
I have a podcast called Dead Cat, too. You can listen to that with some
I didn't know you have that. Wait, you're doing that with somebody?
I'm doing it with Tom Doton at Business Insider and Katie Benner at the New York Times. We had Parker Conrad on for our first episode. We just
and Zenefits.
Rippling.
Oh, wow.
Yeah. And
Rippling and Zenefits, yeah.
We just had Max Chafkin on to talk about the Contrarian.
I had him on last week.
You're ahead of us. So,
did you happen to hear my interview with him?
No, I haven't yet. Sorry.
I basically got into it a little bit because there were 2 things in the book I noticed. Did you notice that he was talking about like white supremacy adjacent people like 7 or 8 times in the book?
Yeah.
And then maybe 5, 6, 7 times in the book, he was like, Peter really likes young, attractive, outspoken men. And I was like,
he did say that a lot. But I do think there's a fact pattern there that a lot of the people he likes to associate himself with are.
It's like, what are you getting at here? And he was like, it's just he has a type and it's attractive young men. And I was like, okay, what about, I just asked him straight up, Max, do you think he's a white nationalist? Because you keep mentioning the white nationalist stuff. And he's like, no, I think he just likes those provocative people. And he, has the Milo Yiannopoulos.
Well, I mean, I'm not saying this makes somebody a white nationalist. I mean, he's very anti-immigrant, clearly. I mean, he's like a hard line on immigration. And he definitely is big on the, we should be able to say whatever we want, which is often coded as I should be able to
say bad words.
Well, not or just
have dark thoughts.
Right, have dark thoughts about race and affirm. Just that's often the subject when people say, "Oh, I am not allowed to say what I think." It's like, well, what's the thing that you really want to speak about? I don't know. This is a huge.
It was a good guess. I actually enjoyed the book. Knowing all the principles in the book or most of them.
Right.
And having watched, the last 20 years, by their sides, it filled in a lot for me. I actually I thought it was a well-written book. I thought he did a good job at it. I thought he was overestimating how scared and, Peter Thiel's footprint in Silicon Valley. I don't want to say Peter Thiel's not relevant in Silicon Valley, but he's not in Silicon Valley. He's not really since Facebook and Palantir. It's not like he's not even running Founders Fund. There's people, Brian runs Founders Fund. It's nothing to do with Peter, really, it feels like. So
yeah, it's always hard. It is a key question is how big is Peter Thiel? Because then it's how worried should we be? How much should we hold it against Founders Fund. Yeah, I don't have. It's hard. I mean, still on the board of Facebook. I mean, to me, that's is an extremely powerful place to be. I mean, Palantir is a huge government contractor. Anduril is probably going to go public in the next 18 months. Like, I think that, he's doing a lot. And obviously, this is someone who took down Gawker sort of in a long play, sort of quiet game. And then I think
for media people, that's the thing. Right, media people overestimate huge. Because, and I told them, I was like, Max, he's like, this is a big existential threat. I was like, how many other publications has he shut down?
It's a big impact on freedom of speech. I mean, just as somebody who's writing independently, like I think about it a lot,
Yeah, but you also don't print revenge porn and sex. Sure, so but you're not ever going to get sued.
The fact that you can sort of lose the one they lost. Yeah, there's
a sex tape, a stolen sex tape.
Yes,
I mean, if they had if the stolen sex tape for Hulk Hogan was in your inbox, you would not print it. Right. 999 out of 1,000 publications wouldn't.
If the law isn't there to protect you, it's good to avoid having enemies, and doing things that might antagonize people needlessly becomes risky, which impedes journalism. So, that's the flip side of it, because you don't want unnecessary enemies or, obviously I'm much more conservative than Gawker was, but if that lawsuit didn't exist, I would be a little freer than I am today.
That's interesting. Wow. I didn't think it was actually impacting people's behavior. All right, listen. Thanks for coming on the pod. Bye-bye. All right, welcome back to This Week in Startups. Matt Newberg runs something called HNGRY TV. It is HNGRY.TV. Get it, hungry without the vowels. A cool naming convention. He's been doing that for a couple of years now. And it's just a platform exploring how technology shapes food, the stuff we eat. And he's got a trends newsletter, and he covers food tech. And that obviously is something that is becoming a giant business, from Whole Foods and Amazon to Postmates, Uber Eats, DoorDash, and everything in between. So we're going to talk with Matt about the state of the industry. Welcome to the program, Matt Newberg.
Thanks so much for having me, Jason. Awesome to be here.
Oh, you probably heard my introduction of you. Did I get it approximately right? You run a newsletter company and a media company. If people want to sign up for your newsletter, they go to hungry.tv without the vowels. And you are on the Twitter at the Newbie.
The Noob.
The Noob. Just put it together. The Noob. So why don't we kick off a little bit with how the COVID pandemic impacted food delivery, grocery delivery, and everything in between, because you also have beverages in there and convenience stores. It's a big sort of sweeping revolution that happened where people who had not previously used these services were stuck at home in quarantine and obviously downloaded the app. So I'm curious as to not only what happened during the pandemic, which I think we can all guess, but what's happening right now in what we hope is the waning days of the pandemic. And depending on which state and city you go to here in the United States, there's either an incredible pandemic and people are wearing masks and socially distancing, or it's a free-for-all depending on the state. So tell us what's happening now in this hopefully waning days of the pandemic to the food delivery industry.
Yeah, it's a great place to start. So like looking at the overall food industry across restaurants and groceries, there's constantly been kind of this food away from home, food at home kind of paradigm. So in aggregate, it's about $1.7 trillion in spending. And what happened during the pandemic was, as restaurants closed their doors, we saw about a 20% decrease away from restaurants, and a real big boost to grocers as people stocked up on groceries. But simultaneously within that, we had a massive growth in both online e-commerce for restaurant delivery, for takeout and delivery. And we also had a huge boom to online grocery, which I think is probably the biggest amount of growth. So in restaurant food delivery, I believe we went from about, don't quote me exactly on this, but like something like it's like 7% food of total food sales going towards delivery to somewhere now about 10%. It's mostly takeout, and then when it comes to online grocery, went from like 2 to 3% to 10%.
Wow!
So that's the major jump. That's where Instacart really came in and saved the day for a lot of grocers. And now here we are. People are waking up and saying, we need to do this ourselves. Grocers need to become technology companies, which is a very big challenge. And that's why now you're seeing a lot of the 10 to 15 minute vertically integrated players eyeing this TAM of delivery of grocery, which is about $1.1 billion, $250 billion of which is going towards your traditional fuel convenience stores. And then the rest, the other $850 billion is, your grocery outlets. So, we went from 3% to 10%. And in the next 5 years, we're expected to go from 10% to 20%.
Wow.
So that's a steady, 2% growth every year for the next 5 years. And,
And so based on what you're saying there, it feels like the grocery stores and the convenience stores are saying, you know what, partnering with, Instacart, DoorDash, Postmates, Uber Eats, might be fine, but you're saying some of them are just going to decide to do it for themselves and go it alone and maybe stop in the grocery space. Are you saying that Instacart is going to see their delivery service go down because Vons or whoever, Safeway, decides, you know what, this is our core business. If 1 out of 5 customers is going to take our services by delivery, why are we even having Instacart in the building? Why are we enabling their business? Why don't we just be fully integrated, which I believe is what Whole Foods chose to do, correct?
Well, yeah. I mean, they sold to Amazon, and Amazon is building a very compelling omni-channel offering now across in-store, with Whole Foods as the high-end kind of banner and Amazon Fresh is kind of the middle market kind of Kroger banner. And then the online component, which is Amazon Fresh, right? And then for the other grocers, I don't think can even compete because they need a player like an Amazon to come in and completely revamp everything from their purchasing all the way down to the consumer experience and the logistics. So they've kind of cobbled together these solutions. And I believe that over the long term, the Albertsons and Krogers of the world will just buy their technology from the likes of Ocado, Instacart, etc., and use them as picks and shovels if those companies can offer those picks and shovels. But the real interesting thing is the rise of the vertically integrated grocer that's going to try to attack these guys at their knees. So, by offering faster delivery, obviously not the same 40,000 items of products that you would find in a traditional grocery store, but a much more curated set of grocery items, and pantry items for this category of instant needs, which we can get into. But the strategy for these vertically integrated ones, are those like the Jokers and the Getters and the corner stores, which was obviously bought by Uber? This is this new category of lower number SKUs but quicker delivery time, correct? Vertically integrated, yeah. And that's kind of the key here. It's that, a lot of the labor laws in this country and abroad do not support, sustainable delivery at high penetration volumes. And you see this with DoorDash is now betting heavier, more and more on DashMart, which is their vertically integrated solution. So they're actually making margin off the product. And I think you're going to see a lot more players enter the space because there's been proven models abroad with the likes of Getir, as you mentioned, or however you pronounce it, Getir, and Delivery Hero that have, really built billion-dollar businesses through dark kitchens and dark supermarkets, D-marts, dark stores that have basically transformed, vacant retail on Main Street or off of Main Street and transformed it into kind of a last mile infrastructure that house commonly ordered items from local bodegas or random, corner stores.
So what we're seeing is there was this model where Postmates or Instacart, I think were the ones who pioneered this, would send a Postmates, I don't know what they used to call them, but a Postmater, I don't know. They would call them your Postmates. It was like a personal shopper, basically. Or Instacart would send a personal shopper for you, a shopper, to a store that already existed in the world, buy your stuff, deliver it, charge you a markup. But if you're, Joker or I guess this new corner shop, the concept is that Uber's corner shop would inventory the items themselves, have the drivers there. It's one app. It's not two different parties involved in the delivery. It's just one party. and it's a lot more seamless. If you have a return, if you have an issue, and then it knocks 10 minutes off the average delivery time or something.
Yeah, I mean, you go from a traditional, I guess Instacart was offering 1 to 2 hour delivery. Now they're offering 30-minute delivery to kind of compete against these guys. Getir kind of pioneered the 10-minute model. We're splitting hairs at some point. It's like, really what this is about is a land grab for customers in certain markets. And the way to do that is to go plaster a bunch of billboards and say you're going to offer free delivery in the fastest amount of time. Gorillas is doing it in 10 minutes. Joker's doing it 15 minutes. There's one that's even called 15-20, which in the name implies 15 to 20 minutes. Does it really matter? We can talk about that. I don't think it really does between 15 and 30, but it is a land grab right now.
Let's talk about that. When I order my groceries at the house, we have 3 or 4 different people who might be contributing to the order. We have a little iPad in the kitchen that we all use. Hey, the order is going in today. The groceries will be here later tonight or tomorrow. And like you're saying, if we're ordering like, $200 or $300 worth of groceries, which is with the 5-person household, what we're kind of ordering, I think it's probably $150 to $200 every time we order something. We don't care if it's it would be nice if it was 15 minutes, but we're not ordering that for food to eat tonight. We're ordering that food for the next 3 or 4 days. So this might be marketing, or it might be unnecessary, is sort of what you're saying for grocery delivery. But for, I ran out of deodorant or razors or milk, maybe that's what you want 15 to 20 for. Am I correct in my assessment of that?
You might want, you don't need it in 50. Do you really need it in 15 minutes?
Not at all. No.
Right. It's just you're doing a calculation on your time is very valuable, Jason. We know this.
Very true. Very true. Thanks for pointing that out.
And your arbitrage, there's this like flexible, you could do this arbitrage now where you can outsource certain parts of your life.
Lots of it, yeah.
And so it just has to be better than whatever you can do yourself, and you're willing to pay that premium. And they're making it, they're using the margin of the products that they're selling to subsidize the delivery and some VC money as well. But you're going from a world of DoorDash making contribution margins as a percentage of the GMV that they process of 3% to a potential model where you get about 17% net margins at the store level for these dark stores. And that's after you account for the cost of delivery and maybe charge a $2 fee to make sure that no one's abusing it and just getting a single tube of toothpaste delivered in 15 minutes, which a lot of New Yorkers are doing right now just to kick the tires.
So they don't have a minimum on some of these, therefore people are abusing it. Yeah. And that is exactly, for a little history lesson, in 1998-99, Cosmo had no minimum. And at our office, we did as a joke, 5 of us all ordered a pack of M&Ms because we were writing a story on it at the same time, and had 5 people show up at the Silicon Valley Reporter office, each of them with a pack of king-size M&Ms we bought for $3 or $2 at the time. And, gave them a $2 or $3 tip, and we're like, these guys just lost $20 delivering this. But I guess that's their way. They're acquiring customers. So if they let you have no minimum for your first order, who cares? On the converse side, I just saw news that Amazon for Whole Foods is saying, starting, even if you have a Prime account, it's going to be $10 per delivery, flat rate. Explain why the smartest kids in the room who have the most experience with e-commerce have decided to go another direction.
It's a great question, Jason. I think it's my take on that. And as I told my readers the other week, was that $10 basically positions you. I don't know if you've ever read like Predictably Irrational by Dan Ariely, but he talks about, pricing pages, and everyone always goes for like the middle tier.
Sure.
So I think my personal take is that they did a test. They did a test in like a few key markets like Detroit and maybe Boston, a few other metros. They saw that there was basically very little price. People were fairly inelastic. The demand was fairly inelastic when they raised the price. They realized that actually like helped the average order economics, and then basically used that as a way to propel Whole Foods as the premium tier offering of Amazon, and that Amazon Fresh would be the kind of free, default middle tier kind of offering, and they're going to expand that banner across the US very aggressively to augment, to give you that kind of 360 omni-channel experience that's emotional to connect back to the online ordering. So I think this is a very calculated play. A lot of people looked at it and said, Amazon is doing this because they can't get grocery right. I mean, I was actually signed up last summer to be an Amazon Flex driver to do some of these Amazon Fresh deliveries. And I can tell you that their cost per order, as far as the delivery, are some of the cheapest, if not the cheapest in the industry. About $1 per bag that I delivered went to the fulfillment cost.
And when you say fulfillment cost, you mean to you as the driver?
Yes.
So what was the typical order size? 5-6 bags? And that means you, as a delivery person, would deliver it in half an hour for $6?
I was making a lot more than that. I was probably making somewhere in the range of $20 to $30, including tips and whatnot. But I could put the article.
Per drop off.
Per drop off. I mean,
per delivery, not per hour.
Yeah. Six or so. It depends on the basket. It really ranged. There was one guy that had like 12 bags, and I had to schlep it up a staircase in 98-degree heat in North Hollywood. There's a couple people that just had 2 or 3 bags, and some people I had to get these 6-pack cases of vitamin water, whatever. So it kind of ranges. How do people treat
the drivers overall? I mean, I try to be absurdly generous. I've done okay, but I'm curious how people treat these drivers. How were you treated? Anecdotally, did you feel like people were really respectful and thankful to you, or do you feel they were giving you terrible tips and just abusing you and abusing the service and kind of took it for granted?
I mean, my interaction with these Amazon customers was pretty much non-existent. They stayed inside their nice homes and their gated communities. I drove in. I had a very calculated route. The reason why Amazon is so good at this is they have a milk run. I do a single pickup and multi-point drop off within an hour, and able to make some of the best rates in the industry because they've basically they have all this demand, and it's been promised within a 2-hour window that maybe came in the morning.
How many orders would they send you out with? 2, 3, 4?
Yeah, maybe like 4 or 5 max. And they know this. They knew that I had a Jeep, so they knew exactly how many packages to give me, how many bags to give me per pickup. And then you just kind of do like you return back to the store. And this is kind of why the vertically integrated model works really well, is because when you deal with like a DoorDash, you could be 1 minute picking up fried chicken sandwiches at Dave's Hot Chicken. The next minute, they're going to send you into an Albertsons to go shop a 50 item order. And the context shift for me as a driver is significant. And, the efficiencies are kind of lost when you start running around the city, and it's just, I'm dealing with all sorts of random, temperatures of food and perishables and non-perishables. And I don't want the eggs to break. I don't want all this stuff to happen. So it's very tough when you're doing all this crowdsourced labor. And we can talk about the labor. There's definitely lots of nuances there.
One more point on the $10 per Whole Foods order. I saw that as a way, I interpreted it slightly differently, but I do appreciate your interpretation. You're probably right. Maybe mine is the second reason. I thought if you are going to do an order and it's $10, and many people do this, and I do it, even though it probably doesn't apply to me anymore. I go, oh, it's $10. All right, I'm going to not do a $50 order. I'm going to do a $150 order because I might as well get the pasta I was going to get next week. I might as well think this through. Whereas with Amazon Prime, they specifically trained me to not care. And they're like, would you like these all in one box, on Thursday? Or would you like 2 boxes Monday and Thursday? And I'm always like, well, of course, I'll take it faster. Sometimes I feel a little bad about the environmental stuff and I really don't need it. I will wait 2 days just to get 1 box instead of 2. And it's literally, I think I'm making that decision based on, do I want to open 1 box or 2? Talk about privilege. The 15 seconds it takes to open a box is part of my thinking. This is how far we've come in our entitlement. And then the second one in terms of entitlement is like, I'm just feeling guilty about the environment and saying, I want 1 box, not 2 boxes, which I guess is the more valid one. But is it also a play to get the ticket sizes to go up? And what role does ticket size play in all of this, if any?
I think that's a really valid point. I think you have to think about, as a consumer, not what's the what percentage of the delivery am I spending on the actual delivery cost? And if it costs more for me to order, if I'm spending more on the delivery fee for my dinner tonight than the actual food itself, we have a problem. And that's when you start to see people try to think about what they might need in advance, for the rest of the week, and become a little bit more economical about the number of frequent, trips that they're going to take. And, the one thing tying back to the quick commerce is that I think these quick commerce guys that are doing 15, 20 minutes aren't targeting the weekly stock ups that, Amazon, Whole Foods, and Fresh are targeting. They're targeting, the 2 to 3 top offs that you would do in a week, that for the random recipe that you're trying to cook that day, you need some veggies, you need some spices to complete that recipe. You didn't necessarily know what you were going to cook that when you did that Sunday, weekly stock up. These guys are attacking the grocers by going after those supplemental trips.
Yeah. So you're cooking dinner, you realize you're out of lemons. You're like, I do need lemons in 10 minutes. I'm going to take advantage of that opportunity. And hey, since I'm buying lemons, I might as well buy some ice cream for dessert and, get some croissant for tomorrow. That's kind of what these 10-minute commerce companies are aiming to do. Am I correct?
It's funny because I spoke to a guy named Barnaby Montgomery who runs yummy.com, and he says that customers don't have oops moments in the kitchen.
Oh,
and he says that like no one is just cooking a recipe and says, I'm missing an egg, let me order it right now.
Yeah.
But it is more convenient, and it is a better way of living, because I can spend more time working on my job, making more money than, and let someone else go and deliver that for me. It's because I have to go drive to the store, pick it up, shop, and check out. And that could take, an hour just to get a few things.
Why did this happen in Europe so quickly? Because we're now looking at 10 companies that have gotten significant funding. This Getter is from Istanbul. They have a total funding of $1 billion. Grill is from Berlin, has raised over $300 million. They're at $1 billion valuation, and cooking with oil, obviously. And then you have like Flink in Germany. Zap is UK based. Dija in UK, small. Gope, and that was acquired by GoPuff. And then you got Jiffy, Keiju. I know this was also very big in China, but why is this landing in Europe as a major trend? Any theories there? I have some, but I'm curious yours.
Yeah, so there's it's definitely a lot more mature overseas. So I think Delivery Hero may have been the first one to get into this. Mm-hmm. But I think a lot of it comes down to the fact that they know that the labor laws and what's going on as far as being able to you saw what happened with Uber in the UK. We know that this is at risk as far as being able to rely dependably on gig labor, and so a lot of these guys are doing full time whatever their equivalent of W-2s are. So they actually
so they're doing shifts.
Yeah, they're doing
they have shift workers who come in for 8 hours or 10 hours or whatever it happens to be, as opposed to people being able to set their own schedule, which fits into the model of the European way of looking at employment, which is you've got employment that is much more stable and less entrepreneurial, saving the judgments. I'm sure some people in Europe would like to have flexibility, but their system, I think, trades flexibility and entrepreneurial nature for, more security, right? Is it also because of the density of European cities and the fact that these little convenience runs, the propensity or the how adapted the cities are towards mopeds or Vespas?
Yeah,
because
absolutely.
One thing I noticed is just, it seems like all these services are using Vespas, which can go 35 miles an hour, and they typically will outrun a car. Whereas in the United States, we're talking about largely suburbia, infill, which is between suburban areas and the city. So you would have like the city of San Francisco, you might have some infills, which might be, I don't know, the areas surrounding the city, and then you have the suburbs. We kind of think about infill and suburbs first for delivery here, and then the density of cities maybe second.
Exactly. So they're attacking these kind of cities where there's a lot of e-bikes that are roaming the streets, and like there's a guy named Carlos Marino who I believe is French, and he's pioneered this idea of the 15-minute city. And this is the idea, a very European idea, that within 15 minutes you're within a subway or a subway ride or a walk from every major social service that you might need. Bars, restaurants, grocery stores, hospitals, all of these essential services are are accessible within 15 minutes, and that's kind of where these guys are playing. They're playing in cities like Berlin, where I don't remember the name of what they call their bodegas, but there's a bodega like that on every block, and people,
a convenience store,
a convenience store, and they tend to purchase a lot of their daily like fresh produce and meats from these corner stores, and get their weekly stock up of their pantry essentials. So it's kind of this like their express orders are more of the fresh stuff that Gorillas is really over indexing on, which is like the meat and the produce that they do on a daily basis. They go and shop for their fromage and their meats.
Yeah, it does seem like these Vespas and e-bikes are a part of this. So what's your prediction for these 15-minute services? Because they're losing money on every order, it seems. They're underpricing it to get people to create accounts. Is this a sustainable business? Is it a bad business? Or is it a good business? Because if they do have to actually put the cost of the driver in there, I'm assuming they're adding $10 in Europe, $15 to each order in terms of expense, because people get paid well and they have to have benefits, and you pay a lot of taxes in Europe. So in Europe, if they're adding $15 to every order, does convenience store delivery of $30 ticket make sense when the delivery cost is 50% of the order? And are people not going to walk downstairs and just buy it themselves when they get home?
Yeah, I mean, that's a great point. That is going to be the test of time is for these guys, is that the percentage that they're spending on the basket on the delivery cost. And in certain markets, you're going to have higher spend and higher cost, right? And then in certain other markets, I think in Turkey, the labor is much cheaper. So, the delivery cost as a percentage of the AOV, the average order basket, is it's lower. So, so that's kind of it's all about the ratio there. And so what the opportunity that these guys are seeing is that this could eat, the small to middle tier convenience stores and retailers in the U.S. So obviously that's a $1.1 trillion TAM in the U.S. I don't have the figures for global, but that's kind of what they're looking at, and they think it's a more sustainable model because you're basically inventorying a store based on what people are ordering the most frequently.
Right, you're skimming the cream, so you don't have to have as many SKUs. Instead of, a grocery store has 30, 40, 50,000 SKUs, you're talking about what at these stores, like 5,000 or something?
It can range from, so Getir does like 1,500, GoPuff is like up to 5,000. Some of the BevMos it's acquired, we can talk about that. But
BevMo got acquired. That's incredible. That was a very popular company with its own built-in delivery service. That I use BevMo here in the Bay Area, and you can put your order in on their site. It has a certain window. Is it as good as like using Instacart, Good Eggs, Uber Eats, or Postmates? No, it's janky. But I used it on the website, and it was okay. It wasn't terrible. It was kind of like a 1.0 if, Uber and Instacart are 3.0 in terms of delivery service. It was like a 1.0 delivery service, but you pick a window and it came. They were using outsourced drivers at BevMo when I used it here over the summer in the last couple of months. But I had an okay experience. It seems to me convenience stores might be not a great business. It's okay. Maybe they have a low margin, but alcohol is high margin. So is the play here that you have an okay business that creates a floor and then you make your profit on alcohol like restaurants do?
Absolutely. I mean, I think that's why I would put GoPuff as one of the winners in the space. And I think there's going to be different winners for each part of the market. And you might have to segment that by East Coast, West Coast, Biggie, Tupac. Yes, I do think that the gross margins of a GoPuff are much higher because they've actually gone through the difficult work of acquiring offline retailers, and they'll go acquire it for like halftime sales and then go raise at a 13x multiple off of that total revenue base between GoPuff and BevMo, and that's what you kind of saw.
Here's a question from our live audience from LinkedIn's live stream. Thank you, LinkedIn, for including us in the live streaming beta. Works really well, by the way. Bram Berg asks, what unique real estate conversations conversions or repurpose plays are you seeing in the last mile industry, retail space, especially in the commissary/cloud kitchen space? So what's happening there in terms of real estate plays? Because those are real estate businesses more than delivery businesses, correct?
You're talking about cloud kitchens versus...
she's asking about cloud kitchens, commissaries, specifically.
Yeah, I mean, I think the number one player here is Travis Kalanick's Cloud Kitchens, which is, basically buying distressed real estate and converting it into, basically this last mile infrastructure that is quietly powering lots of delivery transactions, mostly delivery, although they have like a facade in front, just so it's not blight in a neighborhood and it's not looked at as a some tech company's
abandoned
warehouse
building or whatever. Yeah, they look good. There was one across the street from my office in the city in San Francisco that looked great, and there's some decent technology going on there. I would order from Starbird and Belcampo, two really great brands. And when I would order from those brands, which just have incredibly high quality chicken and beef for Starbird and Belcampo respectively, I would go there to pick up, and it was incredibly sophisticated where they had all the drivers coming in. The drivers could see, on panels where their stuff was. The food was in lockers. And man, they were cranking over there. And if you pick up your stuff on Uber Eats, it was $0. So I was like, I need to get fresh air. I want to go for a walk. So I'd walk across the street and pick up my chicken and come back. And I'd save $7 or $8 on the delivery cost. And it was the reason I did it was faster. Like, I don't want somebody to drive around the corner with my stuff. It would take twice as long. But they seem to have some pretty great technology going at Cloud Kitchens. Yeah.
They basically had to build it all themselves from the ground. So if you look at Cloud Kitchens is really just an umbrella. It's just one business and an umbrella of a lot of other companies. There's a company that owns the real estate. There's a company that owns a tablet that pipes into all the third-party marketplaces. There's a company that owns these virtual brands with funny titles that sound like BuzzFeed articles. There's another company that is Cloud Kitchens. And so it all kind of accrues back to the real estate, and they're able to generate, abnormal returns on the real estate because they buy them cheap, and they're able to charge very high rents per square foot that are abnormal.
If you're a chef and you're looking to open a business, in a city, what does that cost compared to opening a delivery business for every one restaurant and storefront you would open as a restaurateur, how many Cloud Kitchens could you open in how many cities? 5 to 1, 10 to 1. I don't know. I'm taking a guess.
Yeah, you could. So you need to spend about $50,000 to $100,000 in upfront capex just on the kitchen equipment, and then you're going to spend about. The lease is about, maybe I'm a little rusty on these numbers, but maybe some in the range of around $6,000. Plus they take, something around 5% of your sales. So all in, you're looking at, 80, 90K. And if it costs you it costs you $1 million to open up a store. Yeah. So it's about
10%, 5 or 10% probably.
Five Cloud Kitchens for every physical restaurant, but you can amortize the cost of that kitchen equipment.
Yeah. And so you think about it, like if you are a restaurateur and you've got some amazing brand, man, and you could always open 3 brands. I mean, that's the other thing that's amazing about this. I heard you talking on another podcast about the early days of Uber Eats. And I guess Jason, who was running it at the time, said they knew that, from the data, hey, there's no ramen. People keep searching for ramen. There's no ramen store, or we're under ramenized. They just said, hey, to 3 or 4 other kitchens or Cloud Kitchens, you might want to think about ramen, and you may hit a winner there. So I think that's pretty extraordinary, no?
Yeah, absolutely. And that's kind of where this is all going. I think the tech companies own the demand, right? DoorDash, Uber, Instacart, they have so much great data. Now they go back to their retailers and say, hey, we know that there's this demand at this hour of the day for this particular item, whether it's, a late night burger or pizza, whatever it is. And they figure out if you have the right ingredients, you could go and, satisfy this demand on our marketplace. And it kind of works for the restaurant because it's incremental. It works for the marketplace because they get increase in, GMV. And, and the customer gets to have some product at the last mile delivered in, 15, 30 minutes that they wanted that wasn't there before.
Yeah. I mean, one example was boba. Like you could be running any food service and you see boba is trending in one neighborhood, but there's none in this neighborhood. Buying a boba machine is de minimis, it just slaps the label on it. So now you're making, chicken fingers or chicken wings, and you just add boba, and you add another boba brand, and it just sort of combines it there. Here's a question from Bob G. What innovation in both hardware and software in the future will have the most impact on food delivery? Great question. What hardware? Let's start with hardware. What hardware, software combination is going to have a big impact?
On the hardware side, I think, these automated make lines. So Sweetgreen acquired a company called Spice. There's another company called Hyphen. What you're going to start to see probably sometime next year is that a lot of the major QS, fast casual brands, the Dig-Ins and Chipotles and Sweetgreens of the world experiment with, some physical. You're still going to have somebody greet you in the store, but for the off-premise orders, which could be 2/3 of their sales, they're going to have some sort of automated conveyor belt that comes down, and you're going to have your bowl being you're going to have different hotel pans. They're these big pans where they store all the grains and the tomatoes and the lettuce, and it's just going to come down, dispense it neatly in a nice little radial pattern, and you won't even know that it was made by a robot.
So this will take out the need for prep chefs or whatever. Or maybe they'll just be prep chefs and the people who put the salads together. We're investors, of course, in Cafe X, which just reopened at SFO and is doing just amazing. Like they are outperforming the other coffee stores, and they can be 24 hours a day, 7 days a week, and require 1 hour of intervention per day just to change out the milk and maybe, do a couple of quick cleaning things. So the other one that I think is interesting, so you have robotics to prepare the stuff. You have full robotic solutions, which is really only one, Cafe X. I don't think anybody else. I've seen tea and frozen yogurt, pizza. Everybody's tried a different full service. Itza, my friend David Freeberg, was kind of starting with that kind of process, and then he moved on to doing software. There doesn't seem to be anybody who's figured out a full robotic kitchen yet, right? Like the hamburger one, I guess, was called Momentum. I really was rooting for them, or the pizza one. It doesn't seem like we're close enough there, huh?
I think you're going to have it's going to free up a lot of the labor to focus on hospitality, and there's still going to be probably prep that needs to be done. But as far as the make line, the actual production process of, whatever you do from a scratch cooking perspective, that, a lot, or the assembly lines of a burrito, those kind of really mechanic things that someone's doing kind of almost in a robotic like fashion to begin with are going to be automated.
There's one company doing a French fry automation for fast food restaurants, and Miso Robotics, and I had them on the pod recently. And that seems to be pretty, they've only got like 5 or 10 of them, I think he said, in operation, but I think you'll see, like, if you can really define the work, like French fries, you could have the French fry station just operating and behind plexiglass, and the, people who are making the burgers could be keeping an eye on it. It's really interesting. And then you had, of course, Mr. Beast Burger, which was a lot of fanfare. He organized a bunch of restaurants to just be his cloud kitchens. It was kind of like a reverse cloud kitchen. He said, hey, if you can make burgers, you can be part of this. And then he used his brand. What do you think of these virtual dining concepts? Is that something that we'll see a trend on, or do you think that's just like a one-off experiment that didn't work or did work?
I think this is just the beginning. I think I would call them host kitchens. So you have, Chili's created this thing called It's Just Wings. And they were able to do that out of their existing stores. And so you're going to see a lot of like multinational brands are already getting into these secondary concepts. And sometimes it's franchise stores, sometimes it's corporate owned stores. But it can really be a boost to their bottom line. And it is incremental because it's not like someone, if someone orders it on the delivery marketplace, you're happy to pay that commission because they weren't looking for, Chili's. They're looking for wings, and it just so happens to be fulfilled by Chili's. So,
wow.
There's a company, Ordermark in LA that's doing similar stuff with NextBite. They're getting celebrities in on it. I think that the celebrities will churn and burn, but I think the premise of, restaurants are able to crank out, multiple of what they were able to do in the off hours to fill that underutilized capacity is here to stay. Whether it's a celebrity brand or Jason's brand of nuggets or whatever it is you can dream up is anyone's guess. And that's kind of the fun of it.
That's kind of interesting. This Denver-based Nextbite I hadn't heard about, but they did Hotbox by Wiz Khalifa. Get it? Brisket burn ends with barbecue sauce, a turkey burger. Basically, I guess, stuff to eat when you're high. Hotbox, get it? Of course, yeah. Gene Simmons and Paul Stanley of Kiss getting into it. They'll do anything. They sell their brand for anything. But it is a really good idea. And what an interesting idea for Chili's. And I guess they own that Maggiano. But you have this incredible footprint and you say, yeah, let's just serve. Wings are easy. You can teach people how to make wings. People love wings. Wings are high margin. So at some point, like Starbucks is going to look at this and say, hey, we have X number of Starbucks stores. We could have like a little thing in the back of the Starbucks store, or we could come up with a boba brand. And we don't even have to put boba on the menu. We just have a boba cloud kitchen, although they have a strong brand. And I think they do have kind of boba-esque drinks now, I saw. But yeah, this will be a trend that stays. Yeah. Something new comes out, trends, and then everybody in the country can experience it. It reminds me of the Cronut. Remember the Cronut came out in New York and everybody lost their minds about it? And then people started on the West Coast, I remember they made their own version of like donut croissants. They got sued or whatever. You can't trademark a recipe, but you can trademark a name. But in the Cronuts example, Cronuts could have been deployed nationally within, 30 days or something. You could just share the recipe and have a cloud kitchen open in every city. So that's what we're going to see. Exactly. What about robotic delivery? Is that going to happen? You think all these little R2-D2 robots we see running around cities? Mm-hmm. It's been 5 years of this. They get made fun of on, Silicon Valley and whatever. But it does seem like, if one of those gets in an accident or gets destroyed or gets run over, it's no big deal. It's like somebody lost their burrito. Nobody lost their life. Mm-hmm. Are those going to become a thing?
Maybe.
And if so, when?
Yeah. I wish I could tell you, Jason. I think it's going to be, if you think about drone delivery, that's a huge headache because of the FAA regulations. Yeah. Autonomous cars, very difficult as well because you just have so many municipalities you have to go through and you're not going to be able to, just brute force your way through here the way Uber used to. So it's just not going to work like that. It's going to have to involve the cities. And so you're going to see pilots right now already, KiwiBot on, college campuses. And I think it's going to work in like corporate campuses, educational, like colleges, universities. But as far as like, connecting the whole US into a network of autonomous last mile delivery, it would probably be DoorDash's dream to have that, but that could be decades away.
The most interesting thing I saw as an investor, an angel investor, somebody pitched me on this food delivery service on campuses where students would have a big backpack with, 50 items in it, bubblegum, whatever, mixers, whatever, beef jerky, and they could just run around the campus. Anybody who wanted something, meet me here. I'll bring it. Have you seen anything like that? Like that would be like the 5 minute, getting down to 5 minute.
It's where like the pocket watch guy in New York City, like, hey kid, you want a Rolex or something?
Exactly. Do you remember that company? I was trying to figure out what the name of it was. Or had you ever heard about that one?
No, but there's one at UCLA called Duffel that's doing, basically the last, the 15-minute delivery on college campuses as a franchise.
Maybe it was Jetpack. Yeah. Sugar, formerly Jetpack. I'm looking at it right now on Republic. Interesting. The problem, there are countless moments when you just need something right away. On every college campus, students need certain product right away. I think they're talking about condoms. During these moments, stores are either too far or close. Yeah, that would describe it. Or students just don't have the time or energy to travel. Traditional delivery firms take too long, but yada, yada, yada. Interesting.
There's a cool one I covered recently that was out of Y Combinator called Cash. And it's basically a standalone kind of, I think it's temperature controlled kind of vending machine that only DoorDash and Uber Eats and delivery drivers can access. And you can create any kind of virtual storefront and house that with a certain number of SKUs. And you can deliver kind of in any area. You don't necessarily need a physical retail presence. That's an interesting one.
That's interesting. So they make the software, the vending machines,
and the hardware.
Interesting.
CACHE. CACHE, like browser cache. Cache.
Gotcha. That's interesting. There was another one, which I think was called Bodega originally until they got shamed for cultural appropriation, which was I would say that's an homage, but okay. Don't cancel me. I thought it was an homage. That seemed to be a brilliant one. I don't know what they changed their name to, but I had seen one of them, and it was a beautiful, like credenza with glass doors, and you could see all of these different beautiful items. You use your app, the app unlocks it, you say what you want to order, and it says, yeah, the Kit Kats are there, and the battery pack is there, and your lightning cable's there. Just take one of each on our system. Yeah, you could clear the whole thing out, but it's got a camera in it. We know that you were the one who opened it, so we got your credit card. If you steal everything out of there, you're going to be in trouble. I'm going to charge you for it. Bodega is now called Stockwell. That idea is going to work or not?
That one, I think, had a hard time because, they were targeting a lot of offices and it was like hard to replenish these things.
And bad timing.
Yeah. So I don't know. I think the trend of like co-locating like ghost kitchens inside of apartment buildings that are like, expensive rent. It's like a captive market for, a guy like Sam Nazarian has a company called C3, which I think SoftBank invested in, and he's doing, all sorts of concepts out of a single kitchen, crispy rice, umami burger, all that sort of thing. And that's coming, real estate developers are actually partnering with him, putting these kitchens in the ground floor retail. You could come and order it off the menu, or if you live in the building, you could get free pickup delivery. Same thing with office buildings.
That's fascinating. So you basically create like a little single kitchen that will get you crispy rice or whatever. But if you have, wow, that's super efficient. So it's almost like having room service at a hotel. Mm-hmm. And if you're in the building, wow, they can just run up with it. Amazing, the innovation here. Well, listen, how can people find out more? You have a paid newsletter that if people are obsessed about this stuff, they can give you $100 a year or something?
That's right. They can pay up $20 a month or $200 a year for now until the prices increase.
Right. People paying for that? Who's paying for it?
Yes.
You gotta
shout out to all my readers out there. A lot of entrepreneurs in the space and investors and operators. But yeah, it's just hungry.tv, HNGRY, hungry with no U, .tv, and you can sign up for the free newsletter if you want to get a taste of the digest, or head over to the paid subscription with Hungry Trends.
All right, Matt Newberg of hungry.tv, thanks for coming on the pod and sharing all of the great wisdom you've learned from studying the space, and we'll have you on again soon.
Amazing. Thanks so much, Jason.
All right, take care.